We are kicking things off with breaking news. The Bank of Canada has increased its trend-setting interest rates by 50 basis points, narrowly expected by the market. The rate now goes to 4.25%. It is the seventh consecutive interest rate hike, the second that we have got at 50 basis points. Remember, they really ramped up their tightening cycle, starting with 100, stepping down to 75, and now here we have two consecutive moves of 50 basis points. There was a thought in the market that we could get 25. That did not play out, at least this time. You're seeing the Canadian dollar advancing on the back of this. We are getting a statement as well. We are not going to get a press release. We're not going to get an update to monetary projections. There you're looking at the reaction of the TSX, which is pretty interesting. TSX typically does not react to what the Bank of Canada does, but it has strongly in the last two meetings. Last time we saw the TSX surge because the bank surprised by increasing interest rates by less than forecast. Here there was a hope that perhaps they might step down again. Again, we did not see that, and so you're seeing the TSX Composite pull back modestly after what was a pretty strong start to the day. Here's what the Bank of Canada is saying in their statement. They say that they are considering the need for further hikes to curb inflation. That's an important line because it was in the last statement as well. And some were talking about, okay, if we do get that 50 basis points, are they going to perhaps talk a little bit more dovishly and perhaps signal that the end is near when it comes to raising interest rates? We've heard Tiff Macklem say that we're getting to the end. We're not just quite there yet. There's a look at the bond market reaction. Once again, the Bank of Canada has increased its interest rates. There was a part of the market that thought it would only be 25 basis points. Instead, we have gone 50 basis points, which technically is where consensus was. Let's talk about all of this, bring in the analysis side of things. We've got two great guests, a familiar face to our audience. We've got the return of Andrew McCreath, who's the CEO of Forge First, and no stranger to BNN Bloomberg viewers as well. Earl Davis, head of fixed income and money markets at BMO, joining us. Andrew, I'll start with you. We got the 50 basis point increase. I know there was a part of the market that thought it was going to be 25. What's your initial take?
They needed to go 50 this time, Amber, but as you said, that one sentence you read from the Bank of Canada press release indicated that they need to consider additional rate hikes as opposed to telling watchers that they will continue with rate hikes. And the rationale would have to do with the fact that when you look at third quarter GDP, which printed up 2.9%, final domestic demand was actually down 60 basis points. So the economy is slowing. However, the rate of core inflation and the job markets just continue to be too hot for the Bank of Canada. So
now that I'm actually bringing up the statement, and before I get to you, Earl, I'd like to just read out that last paragraph. So before they said the Governing Council expects the policy interest rates will need to rise further. So that was the statement in October. I'm reading the statement now for December. The Governing Council will be considering whether the policy interest rate needs to rise further to bring supply and demand back into balance and return inflation to target. Is that a dovish tilt?
It is a dovish tilt, but I think 50 is the hawkish. And what I mean by that is there was an expectation of 50, but a fair probability of 25. In my view, if they would have went 25, that would have said, you know what, that's it.
I agree.
50 says they'll go to 25, and then that's it. So in my mind, there's a minimum of one more hike with a 50, possibly more, but they are coming towards that pause period.
I'm just going to read the second sentence. The Governing Council continues to assess how tighter monetary policy is working to slow demand, how supply challenges are resolving, how inflation expectations are responding. That's similar to what they said with a little bit of a tweak, but that they're mindful of those downside factors of rising interest rates.
Yeah, what's curious about that statement is actually what they did not say. They did not mention employment. And employment's the key thing here. As long as employment stays at the level that it is, that's where you risk the wage price spiral. And that's a key point. So it'll be interesting to hear the speeches going forward.
So up in the in the statement, it's only 5 paragraphs, but up in the statement, they mention employment, but how it's tight.
Yes.
The unemployment rate near historic lows, and that speaks to your point about that wage price spiral.
And it also speaks to the point of the 25 before they stop.
What do you think?
I would agree with what Earl is saying, Amber. I would also point out that wages are of paramount importance to folks that are watching what these central banks do. In my opinion, inflation has gone, too hard, too long, so as to create a significant amount of suffering for most folks on the planet, let alone here in Canada. And consequently, I believe wage pressures are going to continue longer than they historically continue when the job market actually starts to weaken. So I think the Bank of Canada has to be vigilant, but they have to be conscious about the debt levels in this country and the impact that's clearly going on in the housing market, which is a much greater portion of our economy than it is in the United States. So I agree with what Earl is saying, Amber.
On the housing front, and we just got Toronto data, there was one statistic that I took comfort in. Yes, there's a slowdown. You've definitely seen air come out, but you're not seeing forced selling on a large scale. Sales are down dramatically. So households, while things are tighter, we're at least we're not seeing this flood of homes coming to the market because people simply can't afford it.
And you know what? I think that's directly related to employment. As long as people have a job, they could pay the mortgages, they could pay the bills. And that's an important thing to remember. I think one thing is what will be very interesting, and the way I look at it, the easy hikes are done. 2023 is going to be a story about the difficult hikes. So we'll pause, but what happens, as Andrew said, inflation stabilizes at 5.
What about rate cuts? Do you think we'll start pricing that in more meaningfully in 2023?
Well, if you're asking me, I'd say definitely no. The market is pricing it in. I wouldn't say meaningfully, but it is pricing in rate cuts. But I think as we see inflation plateau not at 2 to 3%, but at 4 to 5%, you have to reconsider what the policy is going to be.
I'd like to add a comment to what Earl said about housing. Absolutely. The fact that folks have jobs enables them to continue to pay their mortgage. I would add that the rise in interest rates have not really impacted the housing market as of yet. And that is because of the structure of the books of the banks, plus the mortgages that have been outstanding. I think the housing market starts to get damaged in 23 as opposed to 22. And so I think that as we go forward, we're going to have lousy growth. We are likely to move into a recession. The key for the economy and, frankly, financial markets is what happens to inflation. And again, we didn't plan this, but I'm in Earl's camp here that inflation is going to be stickier for longer. And so the Bank of Canada has a single mandate, inflation. The Federal Reserve Bank of the United States has a dual mandate, inflation and jobs. And so consequently, I think the Fed is going to have a tougher problem than the Bank of Canada in 23, Amber.